maybe going to lend to you. So being organized and evaluating how much you need up front is going to be really key as we navigate this maze. And this is where we spend a lot of time with businesses in at the Small Business Development Center program, helping businesses put together, financial projections. So you might say a business plan to really evaluate, well, how much do you actually need to start that business or to grow your existing business? And it can take some time, but it's well worth it because if you ask for too much money and you get approved, woohoo, you may be financing, well, money or capital that you don't really need. And vice versa, if you ask for too little, you may be, having to go back to the bank and refinance and pay additional fees. So talking with the lender about how much you need and what you're going to use it for will also largely dictate what kind of lenders you're going to be talking to. Now, I always tell clients when they're looking for loans, hey, have you talked to the bank that you bank with? Because you already have that relationship. And sometimes in the world of lending, it is very relationship based in terms of somebody sticking their neck out there with their underwriter saying, no, this is a good deal. I know they're going to do really well. They've done it before, something like that. But talking with the bank that you bank with about your business and having that relationship is going to be really key, as well as if they can't do the loan that you're asking for. Maybe they don't do that type of industry, which we'll talk about in a second, or maybe they don't do loans that small. Maybe you don't need a large loan. In which case they may refer you to other groups like CDCs, and no, not Center for Disease Control, but Community Development Corporations, or CDFIs, Community Development Financial Institutions. These are groups that do kind of lending in smaller dollar, and by small it can be relative, but a micro loan would be something that would be like 50,000 or below. But there's different types of lenders, different types of loan programs, but it really just got to boil down to how much and what for. But so at this stage of the game for my established businesses that may be watching today, I usually tell folks, review your books, really. Look at your balance sheet, make sure everything's cleaned up, and you hopefully have a positive net equity situation there. For my startups that may be on the line watching today, this is where I would say, don't expect to get 100% financing from the bank. You're going to need to come in with some skin in the game to show your commitment to the project or the business or what you're trying to do financially. That's going to be usually in the form of about 25% of the total project cost. So if it's going to cost $100,000 to start this business, you're going to need to come in with a chunk of change to the tune of about 25K yourself. Now that money can be, maybe you spent some big ticket, item, you've bought some expenses for the business, so you can count those if you still have the receipts towards that 10% or 25% down. It can also come in the form of, let's say, a gift from a family member, but it can't be from borrowed sources. You can't borrow money to borrow more money, so to speak. But another thing I always throw out here, if you're buying a business, as opposed to starting a business, you could just as well buy a business. And oftentimes buying a business, it can be easier than financing a startup because there's this like historical cash flow there from the person you're buying it from, income and expenses and tax returns to support it. So, but if you're buying a business, a lot of times it's 10% down, so a little less, and sometimes you go out longer term, like a 10-year term. But at this C, as we navigate the small business loans maze, it's a really important one. I want you to take your time and evaluate, well, how much do you really need and what you're going to do with it. And pencil out some numbers in terms of financial projections, or call your local SBDC to help you do it, because it's a really important aspect, and it's going to show your lender when they say, how much do you need? And you say, I need $82,500 versus I need $1 million. There's right away, I already have an idea of when someone has a number like that they know what they're talking about doing, because they're going to use this capital to hopefully help grow the business as a tool to do so. So sometimes we get the questions, how long does it take to get a loan? And it can vary lender to lender, but I'd say 30 to 60 days. So split the difference and call it 45 days. Do be leery or careful with the click fund kind of loan options. They are out there, but do look at the interest rates and the fees. If they have these prepayment penalty fees or things that are upfront fees that you can't quite understand and you don't get clear answers to, well, make that a note to, well, get that answer. I'll just say that. But once you've had an idea and you can clearly explain to someone, how much you need, what you're going to use it for, and ultimately the next question is, well, how are you going to pay them back? And this C is going to be the capacity C, your ability to repay. And so for the startups that may be watching right now, again, this is where we really dive in deep with those numbers in terms of your income and your expenses that you expect to see through the business. But really, the business doesn't exist. It's a guessing game at this point. So the bank will still give you a microloan or a loan, but they're really banking on your outside sources of income outside of the business. So W-2 job outside of the business, spousal income, rental properties, etc. So they're going to be looking at you more globally, not just the business, but also the owners. Now, for my established businesses, this is key because, a lot of times you'll hear it depends when you're talking about loans for businesses. But this is the biggest C that I've learned over the years to help evaluate the likelihood of you getting approved for the loan you're looking for. And they call it a debt service coverage ratio, but it just requires some basic information. A lot of times when you go to a bank and you're an established business, you've been around, by that I mean at least 3 years or more, you go to a bank and you say, okay, I'd like to get a business loan. What do you need from me? They're going to say primarily 2 things. They're going to see your most recent tax returns, and they're going to need to see a debt schedule, which is basically a listing of all of the debts that you may have on the business as of today or whatever you're asking. So the reason why they're asking for you those 2 documents is because they're going to basically do this. They're going to look at your tax returns to see, okay, how much money did you make last year? Net income, not gross. Total sales minus total expenses equals net income. So they're looking at how much profits in the business. In this example, we're going to say $42,000. All right, not doing too bad. They're going to add back in things that are non-cash expenses like depreciation or amortization, and also interest, because we're going to get to the next step in the debt schedule. So in this case, let's say we have $12,000 of term like equipment financing on the business. We have some equipment, so we have some depreciation that we're writing off in the business of $12,000. So our true earnings, or what oftentimes accountants or other folks will refer to as EBITDA, earnings before interest, taxes, and amortization, our true earnings in the business are $54,000. Now, they're going to say, okay, Sean, where's that debt schedule I asked you for? Okay, here you go. Let's say we have an existing monthly debt of $1,200 to finance that equipment that I talked about. And let's say we're asking for about $150,000 at 9% over 7 years. These are purely fictitious numbers because interest rates do change, but I just threw this out there. And that monthly payment, again, monthly will be $2,413. Okay, so if we have existing monthly debt, and this is what we're asking for, now we gotta look at it on an annual basis. So we're gonna multiply that times 12. And what we're saying here is we've got total debt on the company, both what we're asking for and what we currently have to service, 43,000 and some change. Okay, now all we're going to do is divide our earnings by our total debt to get to a ratio they call in the banking world debt service coverage ratio. And in this case, it's 1.25. What we're saying here is we have $1.25 in earnings for every dollar of debt that we have or are planning to take on. That is kind of like the industry standard. There are some lenders that will go 1-to-1, meaning dollar for dollar, but that's now saying you're kind of highly leveraged in terms of your ability to service that debt from a cash flow perspective. So this is a really aha moment for a lot of businesses when we work with them through the SBDC to kind of go to answer that question, how much can I get? Because it is a very valid question and it deserves an answer. But in order to answer that, this is what you should be doing before you go approach the bank or as you're considering bidding on that project or expanding in a certain way, going, okay, best way to raise money is before you need it. So we're building that relationship with our banker. We're talking to them. They know our business. We know how we're growing. Now, The other thing I'd mention is we kind of end 2020, what year are we in? 2024. We're going to be filing our taxes. So right about now is when everybody's meeting with their accountant going, okay, how are we going to end this year? Should we be buying things this year? Are we going to be seeking financing next year? And whether it's conversations now as we get closer towards the end of the year, or as we're filing our taxes, this is where you need to reconcile your willingness to pay tax with your desire for financing. Because as you saw here, net income was the first number we worked from. And if I'm your CPA or your accountant, I'm trying to get your tax liability down to as low as possible, right? Well, that may be inherently conflicting your desire for financing. So you got to have these conversations with your financial consultants and others to help them understand the plan that is for not only ending this year, but next year as well. Because financing is definitely a long-term kind of game. And if we get a loan today, it may impact our ability to get a loan tomorrow until we pay that first one off. So I like to really hit home on this particular C, this capacity C, the importance of, well, knowing your numbers, doing this quick and dirty back of the napkin kind of example. But let's say, Sean, that maybe we have 0.9, I don't know, something less than 1.25 or, somewhere around there. Well, then what, Sean? Well, obviously you can, qualify for probably a lower amount or, you can play with these terms. But there are some banks, like I mentioned before, CDCs and CDFIs that will do what they call going global. And this particular example that we're looking on the screen is pretty much just looking at the business. But what if, you had other retirement or not, or, maybe another business that could be an affiliate that, has some other profitability. This is where banks will look at the business initially to see if they can cash flow the loan, but then they'll also sometimes go outside the business to the personal owners and what discretionary income they may have. And that's often referred to as going global. Not all banks will do that, but if there is money elsewhere that can help support this profitability C or the capacity to repay, that's where you can kind of draw on your resources there. But that's kind of what I wanted to talk to about there, but also these one-time expenses. So the bank's going to ask you for your tax return, and on there are some numbers. You kind of need to do a little storytelling in this stage to let the bank know, hey, maybe the roof had problems last year and it cost us $10,000 to fix. We got it fixed, but that severely lowered our profitability for last year. And it's hopefully not going to happen again because, knock on wood, we fixed it right. Maybe that AC went out or something other. We got sued. We've seen a lot of different things. But if there are some one-time expenses that may have happened that may have lowered this top line figure, you got to explain that to your lender. And again, can't emphasize enough having that relationship with your banker that will really go a long way. So that's the C for capacity and probably the most important C out of all the 5 C's. I know we're only on number 2 right now, but let's say you're an established business, you're going along, you've got your business plan that shows how much you need, what you're going to use it for, or your budget, and then you've got some tax returns to prove that, historically speaking, you can afford this debt. You're going along, and then boom, do not pass go, do not collect $200. And sometimes that is simply because of the C that we refer to as conditions. And that can be, maybe you're just in a risky industry. I have this slide up talking about the top 10 riskiest industries according to IBS World. It's a little dated back in 2014, 15, but you can get the point. If you're maybe in the DVD game rental business, like Blockbuster, back in the day, I'm dating myself a little bit, but you can tell, like right now, we're streaming this online. You might have the best video game rental business, in your city, but look at the growth rate. It's a negative, 20%. So the bank is going to take into consideration the overall industry that your business is part of. And even if your industry might not be growing, it's important to be upfront with your lender who you're asking for financing from to say, hey, do you even make loans to businesses in my industry or my NAICS code? That's a government classification system that a lot of banks will track loans by. Because not only are they looking at the overall industry, what may be growing, what may be declining. I mean, no one has a crystal ball, but they do rely on like RMA data or these industry research tools to help them in their decision making. And we have industry research tools at the SBDC you can take advantage of. But they're also looking at the past loans that they may have done and who paid them back and who didn't. So let's say I'm in an industry that isn't necessarily risky, but the bank made loans to other businesses in the industry who didn't pay them back. And they're going to be a little sheepish, rightfully so, to go, oh, I don't know. And so they sometimes use this is the Coleman report, but just as an example of all like SBA loans, and there'll be, they guarantee them, so a lot of the information is public. But just take, for example, masonry contractors. This is that NACE code I was talking about. Well, 1,000 loans were made between January 1st, 2009 and December 31st, 2018 for 162 million, and 3.4% were charged off or not paid back entirely. So anything north of 4% kind of puts the bank in a situation where they're going, this is a little bit maybe risky for us, because the bank can only be wrong oftentimes 2% of the time before, well, their regulators start coming down on them going, hey, Bank of Sean, why are you making bad loans? We need to come in and look at your loan portfolio. So sometimes you might be you might have a good business. It's just being upfront with your lender, and they're going to go, hey, yeah, we can't do that loan because you're in this particular industry. Not that we don't love you, Sean, but maybe we have too many loans already in that industry, or that industry is just too risky for us. So being upfront with yourself, knowing that it's not going to be impossible if you're in a risky industry, but it may be a little harder, and you might have to do some more research. But again, we can show you how to look at the top lenders for NACE based on the NACE code for your type of business. But other things I usually throw in here is, in this condition C would be things like, making sure you have all your licenses and permits for whatever business that you're trying to do. Because if there's another, let's say, regulatory agency that gives you a license or a permission to do what you plan to do in the business that you don't have yet, you're going to need to get that, because, well, the bank's going to say, go get that and then let's talk. But that's kind of the short story on the conditions C. I think it's important just being upfront with your lender saying, hey, do you lend to this type of industry, or do you have a preference here? Now, the next C is credit or character. A lot of times people say character or credit. This is, in a nutshell, your reputation. It's your, past performance of paying back other people. So, we have that debt that we talked about earlier in the capacity C. Well, hopefully we're current on that debt, and we have a history of repaying other people. And that will be not necessarily reflected on, it could be reflected on our business credit, but a lot of times banks are looking at the personal credit of anyone who owns 20% or more in the business. A lot of people ask me, Sean, well, I set up this corporation, this LLC, to make it completely separate. And that's great. But the bank knows there's a close relationship between the owners and the business. And if there's a bill to be paid in the business bank account and there's no money in the business bank account, well, where is that going to come from? You, the owner. And so that's what often happens is, sometimes the business will be looking like it's doing fine, but the personal credit or the owners are funding it, and they keep funding more and more, which is racking up debt on their on the personal side, their credit cards or other types of means. So they will ask for personal credit reports for what they call key personnel or anybody who owns 20% or more. And the biggest thing here, I usually tell folks, is nowadays it's pretty common to, monitor your credit with freeannualcreditreport.com or Credit Karma or some of these other credit monitoring services. But know what's on the report before you go in. Heck, I'll print it out as part of my loan package so that they don't have to pull my credit. I can say, here it is. This might not be the exact score that you may be using, but here's my FICO as of today. But know what's on it. If there are any derogatory marks, take care of those if possible before. But really what the bank's going to be interested in here is going to be your why. We've all had tough times and nobody's perfect, but why did it happen? And what have you done since then? But when it comes to things like BKs or bankruptcies or short sales, those are going to be important things to also talk to your lender about. Like, hey, what's the time frame before you'll even consider a loan application for me, irregardless of the other C's? Is there a time window that I need to kind of take into consideration beyond just the one once it falls off my credit? But really being able to explain, hey, why did you have this short sale? Why did you have the bankruptcy? Maybe it was a divorce. Maybe it was a death. There's a lot to unpack there. And being upfront with the lender and being able to tell that story is important. Now, the other thing I would throw into this character credit kind of C, and it kind of throws a lot of businesses for a loop, especially my established businesses out there, is like you may have been working in the business that you've been working in for the last 20 something years, 40 years, plus. And you probably don't have a resume like if you were looking for a job, but your information is going to be put into what they call a loan package. And this is just an example. I think I have one up here. Yeah, okay. This is like our loan package checklist at the SBDC. And you've got just about everything under the sun financially for this business, from your FICO score to your personal financial statement to your tax returns and so on, the lease, the this, the that. But one of these things is management profiles. And your bank may have a management profile sheet that you can plug in. But I would emphasize, drafting a good resume to really articulate your experience running and managing this business and hopefully growing it over time. Because really, all these documents are going to be sitting on a desk in front of an underwriter or someone who's responsible for plugging and chugging the numbers and really understanding this business and who it's run by. And I'm a big believer, I bet in the jockey more than the horse sometimes if I know the jockey is well enough. Like how good are you at managing this business so I can get my money back, right? And so having a good, strong resume can actually bolster your chances of getting a loan in a lot of cases because you're going to be able to show your past performance of running this business. For my startups that are watching it, I would say at least 2 years of direct industry experience is going to be key because, well, the bank or any investor is going to say, well, I don't want you learning on the job on my dime. Why don't you go get a job in that industry and then come back, let's talk after you've had a chance to learn the ins and the outs and you know exactly what you're going to do. And we can put this money to real good use. Industry profiles are going to be, not industry profile, your management resumes really have a good impact on proving to an investor or banker, you name it. It's not just small business loans, it's, getting funding that you can, do what you put in that plan. So I'll get off my high horse on that one, but it's kind of weird when I say, do you have a resume? Because, you can fill out the management profile sheet, but I always like to have something that really sings on paper. So they go, oh, this guy or gal is really, they've got an extensive repertoire. I don't know. Now, we're around in third and we're headed home. So, and I know what you think. No one likes to talk about collateral. This C, my friends, is the guarantee that if everything goes sideways, what you're willing to give up to pay back that loan. And I say no one likes to talk about it because no one does, but every bank has collateral requirements, and you're going to want to talk to them about what those requirements are. They will vary depending on the size of the loan, the type of the loan, what the loan is going to be used for. So, for a micro loan or something under 50,000, they might just ask for a pink slip on a car that you might own. Whereas, maybe if you're financing real estate, they may do a first deed of trust on the real estate that you're financing. But collateral is essentially dollar for dollar. What the bank, if I'm asking for $150,000, the bank is, my assumption is going to be they want to secure it with an equal amount. And that's where I think I have on the next slide this schedule, because that amount may differ depending on the type of collateral that we're pledging, say that we're good for. If we take $150,000 and we get approved for it by our bank and we go invest that in inventory, let's say, well, their discount rate or what they're going to give us is 35 cents on the dollar. So let's make it 100,000, make it easy. I'm not mental math, not my thing. I use calculators. But if we got $100,000 for inventory to expand our business, they're going to give us $35,000 of collateral towards that. Where's the other 65 going to come from for to be one-to-one? That's where they're usually looking at guarantored pledged assets. So your personal residence, your rental properties, your vehicles. And still then, they're not going to give you 100% of whatever your Zillow says or Redfin or your Kelley Blue Book. They're going to discount that by 80%. And that's 80% of the equity. So if you have a loan on that vehicle or a mortgage on that house, it's that lendable equity that they're going to look at, not the whatever the house may be worth. So keep that in mind. But because they're going to discount it because if they couldn't sell, let's say your inventory, the bank's going to go, I'm going to liquidate this if I have to, right? I mean, it's not fun to talk about, but we want to, what is the saying? Plan for the worst, hope for the best. And that's where we go back into that business planning, really making sure that we're conservative in our assumptions and liberal with our conservative with our revenue and liberal with our expenses, so that we have that wiggle room to work with. Now, yeah, if we're buying new machinery or equipment, yeah, they might give us 100% collateral because it's kind of brand new. But and this is just an example. So every bank is going to have different collateral requirements. Again, as I mentioned, for different types of loans. So talk to them, be upfront with them. Hey, do you require real estate as to get this type of loan, or what is required? If I'm a bank, I'm going to ask for everything. But that's where you have to negotiate. Everything is negotiable. I learned from one of my consultants. But what did he always say? Yeah, I'll pay your price if I can negotiate the terms. So, but anyway, collateral's a tough conversation to have, and it may be a deal killer for you personally, because you might go, I'm not willing to put up my house. And on one hand, I can understand the bank going, oh, well, Sean, if you're not all in on this, well, I don't think you're that committed. On the other hand, I can go, well, I can understand Sean because he can go, well, maybe he's looking to sell his house, or that's his nest egg, like whatever. So there's arguments to be made on both sides. But the fact of the matter is, most businesses don't have a lot of assets. I mean, the major asset in most businesses is going to be cash. And what's the first to go when the business is going down? It's cash. So there isn't a lot of book value sometimes on the balance sheet. And so that's where SBA usually comes in to kind of help. And I say help because they aren't the one, you're not getting a loan when you get an SBA loan, you're getting SBA loan guarantee. And I should probably update this little box here because the way SBA loans work is here's you, the business owner, here's Mr. and Mrs. Banker, and here's Uncle Sam, our SBA. You are getting a loan from your local bank that is being guaranteed by SBA. So you go to their bank and you say, I'd like to get a small business loan, please. You might not be super strong in areas of credit, cash flow, or collateral. So Mr. and Mrs. Banker goes over to Uncle Sam or SBA and says, hey, I'd like to help out Sean's business, but he doesn't meet our, he's a little risky on these areas. Will you, SBA, provide a guarantee for me if Sean doesn't pay me back? And that is an SBA loan guarantee in a nutshell. The bank lends you the money with SBA's guarantee of up to 75 or 85% sometimes on the money loaned to you. Basically, it's an insurance policy with your loan, and you will pay what they call guarantee fees. It's sometimes 2.5% of the loan of the guaranteed amount. So let's say $100,000. Let's see, 1, 2, 3 times I'm going to go 75 to be conservative. So the $75,000 is the guaranteed portion that the bank can get back from SBA times 0.025. We'll use that 2.5%. That's $1,875 that I'm going to pay as a fee to close that loan. And sometimes the bank can wrap that fee into the loan. as part of the closing costs and appraisals and other things that may be required to close on that loan. But that's what SBA is able to do to free up capital for small businesses that might not, they're inherently risky. Let's be honest. Business is risky, and banks are in the business of managing risk and getting paid back. So this is kind of how it works in a nutshell. SBA does have what they call a quick SBA loan quick reference guide. If you Google it, it will come up in terms of like, well, the different loan programs they have. There are really two. There's what they call a 7A, which is what most people refer to as an SBA loan. It's for like working capital, things like that. And then a 504. 504 is more for commercial real estate when you're buying the building. And it gets a little more tricky there because you're working with the bank, CDC, and you and SBA to close that loan. But they have all different types of loans, from the maximum loan amount, the percent of the guarantee, what it can be used for, the terms, the maximum interest rates that can be charged, and then the guarantee fees, as well as really the benefits to the borrower being, primarily access to the capital they need to create business, create the jobs, grow, increase the sales, and impact our local economy. So that's a little bit about SBA loans. And now we have finally found our way out of the the small business loans maze. Woohoo! But as you can imagine, as you find your way out of the small business loans maze, it's really just the entrance to the sales and marketing maze, because now you have more debt to service. You got interest payment, the payments for the loans that you got to service. And so hopefully you're getting that loan to implement a plan that will turn, for a long-term investment for you and wealth creation, but also paying back that loan. So I know we went through this kind of quick, but it's really, I know I wanted to keep it focused on some of the highlights. There's a lot we can get into with small business lending, but that's where we offer free one-on-one consulting to help business owners in the community sit down with a consultant to talk about these 5 C's as they relate to their business, their industry, their tax returns, their credit. It gets really personal. So I don't expect a lot of people to drop a lot of questions in the chat saying, so I have this credit score, I've had these losses, so that's where I really want to hit home that you're not alone. And we work with a lot of different lenders in the area, and we kind of help businesses understand what lenders are looking for and get best prepared to put their best foot forward in telling their story. So if you'd like to sign up to become a client, if you're watching this on YouTube or wherever, you can sign up on our website, which is lavernespdc.org. Got a red button here in the homepage. You can scroll down to where it says make an appointment, and this will walk you through our basic application. All our services are free, confidential, but by appointment only. So just sign up and we'll call you to schedule an appointment. If you are already signed up or watching this webinar on Zoom as opposed to social, just give us a call at 909-448-1556, and we'd be happy to set you up with a consultant to talk about your business one-on-one at your convenience. So with that, I will thank everybody for joining us for today. I hope you can see us next time as we talk about how to file a fictitious business name statement with the County of Los Angeles, because it's a common form to file as you're starting up as a sole prop. And but until then, thanks for watching. Hope you have